Look, I was literally in the middle of going through a stack of recent mining industry reports, just sitting at my desk cross referencing production cost data, not planning to make anything today. But then I kept coming back to something a senior executive in the silver mining space said to me in a conversation that was never supposed to be on the record. And I put down everything I was doing because this one comment explains more about where silver is structurally headed than any analyst price target you are going to find on any financial media platform right now. And I think you deserve the full story, so here it is. And I am recording this right now from New York, and I want you to comment what day and date you are watching from, because I always love seeing how far these videos travel, and this particular topic gets more relevant with every passing quarter, not less. And real quick, if you value this kind of honest, ground level analysis of the metals market, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this kind of content. Now, here is the claim making the rounds in a lot of precious metals communities and mainstream financial conversations right now. The claim goes like this: silver is abundant. There are hundreds of billions of ounces sitting in the earth. Global mine supply is healthy. Primary and secondary production is robust. And therefore, price should reflect that abundance, and any supply narrative is overblown. On the surface, that sounds clean. It sounds logical. It sounds like the kind of thing someone says after doing real research. But when you slow it down piece by piece, you realize that is not the whole story. That is not even half of it. And the first place this story gets weak is one single word, and that word is available. Because there is an enormous difference between silver that exists in the geological record and silver that can actually be extracted and refined at a profit given today's energy costs, labor costs, permitting environments, and infrastructure realities. That gap between what is in the ground and what is economically recoverable is widening every single year. And what I am about to walk you through is not a YouTube narrative play. This is geology meeting, economics meeting, timing, and it is the one story the silver market has not fully priced. So in this video, I am going to break down three things. First, what ore grade decline actually means in plain language, and why it is the silent structural killer of future silver supply. Second, why the byproduct dependency of this market creates a vulnerability that most retail investors have never modeled, and that the industry talks about quietly but rarely loudly. And third, what all of this means practically for what you should actually be doing with your silver exposure right now. You are going to walk away from this video feeling calmer, sharper, and more in control of what you own. So let us start with what we can verify, which is the ore grade story, because this is the bedrock of the entire conversation. When a mining executive says off the record that we are running out of easy silver, they are not saying there is no silver left in the planet. They are saying something far more specific and far more consequential. They are saying that the silver which existed at shallow depths in dense concentrations, in politically stable and operationally accessible locations, that silver has largely been found and extracted. What remains in the pipeline is deeper, lower grade, more remote, more capital intensive, and more time consuming to bring to market. Here is the clean way to think about it. Imagine you are running a lemonade stand, and for the first few years you are working with big ripe lemons that practically juice themselves. Your margins are great. Your output is easy. But over time, those lemons get used up, and what is left in the crate are small, dry, tough ones that require 3 times the squeezing to produce the same glass of lemonade. Your cost per ounce of juice just structurally increased, even though you technically still have lemons. That is the ore grade story in silver right now. Based on publicly reported data from multiple major mining surveys and independent geological assessments, the average silver ore grade has declined by somewhere in the range of half to nearly two-thirds over the last 3 decades or so. Down from what? Down from the grades that built the modern silver mining industry, down from the deposits that made the major producers the size they are today. Oh, what we are seeing right now across the industry is that companies are moving significantly more rock to produce the same ounce count they were producing 10 or 15 years ago. And moving more rock means more diesel burned, more labor deployed, more processing infrastructure, more water management, more tailing storage, more regulatory compliance. Every dollar of that added complexity comes directly out of the margin. The math gets harder every single year, and it does not get easier by hoping silver prices rise fast enough to cover the gap. And stay with me on this because it matters deeply. This is not a cyclical problem. This is not something that gets fixed in the next commodity cycle. This is structural geological depletion unfolding in slow motion across the entire industry simultaneously. The high-grade silver assets that define the productive years of the major miners are mature. They are in their later production phases. They are being drawn down. And the pipeline of new high-grade replacement deposits is thin by historical standards. Recent industry exploration data shows that the rate of significant new silver deposit discovery per exploration dollar spent has been declining for more than a decade. You are spending more capital to find less silver. That is not a headline. That is a trend. And it is the exact kind of slow-moving structural reality that does not show up in the spot price until the market can no longer ignore it. Time is the weapon here. You cannot speed run a mine. From initial discovery to first production, you are typically looking at somewhere between 10 and 15 years of environmental permitting. Infrastructure development, community engagement, financing, and operational ramp-up. It is like steering a cargo ship. You do not pivot on a dime. You signal the turn years before it actually happens. By the time the spot market price is in a serious supply deficit, the supply response is already years behind the curve. That lag is not accidental. It is structural. And it is why the people inside the industry who understand the geology are more concerned than the price charts currently suggest they should be. Now, here is the skeptical alternative, and I want to give it real credit because I think intellectual honesty is what makes this channel worth watching. Could technology offset the grade decline meaningfully? Sure, it is possible. Heap leach processing improvements, sensor-based ore sorting, AI-assisted geological modeling. And these are real advances, and they are incrementally improving the economics of lower-grade deposits in certain operating environments. I am going to say something that might annoy both sides here. Technological improvement is real. It is happening. And in some specific operations, it is genuinely moving the needle on cost per ounce. That is plausible here, is how it can fail. Technology adoption is not uniform. A deep underground mine in a jurisdiction with unreliable power infrastructure and limited skilled labor does not benefit from the same innovations as a modern open pit operation in a mining-friendly country with full capital access. The global silver supply picture is an aggregate of wildly different operating environments. And when you aggregate them, the grade decline curve is winning against the innovation curve in the majority of cases that matter for total global output. So, what does this actually mean for you right now? Here is what to watch. Watch the all in sustaining cost per ounce figures that major silver producers report quarterly. When that number trends upward quarter over quarter, while the realized silver price stays flat or compresses, you are watching a squeeze happening in real time. That is the lemonade stand paying more for lemons than it can charge at the window. And those operations do not run forever at a loss. Eventually, production slows or stops, and that tightens available supply. And eventually, price responds. But it does not respond on the timeline you want. It responds on the timeline the geology and the capital markets allow. Oh, here is a question for you, and drop it in the comments because I genuinely read what you write. When you think about the real risk to silver's supply over the next decade, what concerns you more? The ore grade and discovery decline I just walked through, or the political and jurisdictional risk of mining in countries where the rules can change overnight? Both are real. Tell me which one keeps you up at night because I think that question reveals exactly how you are framing your position. Now, let us talk about the byproduct structure of silver supply because this is where the story gets genuinely interesting and almost nobody in the retail conversation is focused on it. Here is the reality: the vast majority of silver mined globally does not come from mines that are operating primarily to produce silver. One, it comes as a byproduct of mining copper, lead, zinc, and gold. Silver is recovered from ore that was being processed for something else entirely. Here is the clean way to think about it. Think of silver in this context like the garnish that comes out with the main dish at a restaurant. The kitchen is not running to produce garnishes. The kitchen is running to produce steaks and pasta and whatever the paying customers ordered. If the restaurant slows down its main menu, you get fewer garnishes regardless of whether anyone is specifically hungry for garnishes. The garnish output is a passenger in the vehicle, not the driver. That is not a rough analogy. That is structurally how a significant portion of global silver supply actually works based on publicly available mine production breakdowns. And here is the implication that most retail models completely miss. When copper demand softens because of a global industrial slowdown, when zinc prices drop because construction activity falls, when gold development projects get deferred because financing dries up, silver supply quietly contracts as a passive consequence without a single decision specifically about silver being made anywhere. The copper mine does not check the silver price before deciding whether to curtail production. It checks the copper price, and that creates a supply dependency that silver's own market dynamics cannot control. Let me be blunt. If you are building a supply-demand model for silver that only incorporates silver-specific inputs, you are working with a fundamentally incomplete picture. You are navigating with half a map. Oh, now the skeptical counterpoint here is fair. Could primary silver producers expand significantly if prices justified it and byproduct supply declined? In theory, yes. And I'm going to say something that might annoy both sides. Primary silver companies do respond to price incentives, and some of them have strong assets and solid balance sheets that would allow for expansion. That is plausible here, is how it can fail. Capital market appetite for junior and mid-tier mining companies has been inconsistent and often insufficient for the scale of investment needed to bring new primary silver mines into production. The economics are challenging even in good price environments because the best primary silver deposits are increasingly scarce and in complicated jurisdictions. And even if the capital materialized tomorrow, the timeline constraint is absolute. You cannot speed run a refinery. You cannot speedrun a permitting process. The cargo ship is already committed to its current heading, and changing course takes years. A correlation is not a contract. Rising silver prices do not automatically generate rising supply within any time frame that matters for near-term positioning. The response lag is enormous, and it is one of the most underappreciated dynamics in this entire market. So, what does this actually mean in practical terms? If you want to understand whether the structural supply squeeze story is building or dissipating, you do not just watch the silver spot price. You watch three specific indicators. You watch silver lease rates because when the physical market tightens genuinely, the cost of borrowing physical silver rises, and lease rates are one of the first real signals that paper pricing is starting to diverge from physical reality. You watch the registered versus eligible split in major exchange warehouse data because eligible silver just means it could potentially be prepared for delivery, while registered silver means it is actually standing by, ready to be delivered right now. When registered inventory declines sharply and open interest stays elevated, that is a meaningful signal. And you watch primary miner all in sustaining costs against realized prices because when that margin compresses towards zero or negative production cuts follow and supply shrinks. Those three together tell you far more than any single headline. Oh, tell me in the comments, are you currently holding silver as a monetary insurance position, or are you holding it for the price upside case? Because those are two genuinely different theses, and they have different implications for sizing, for form, and for how you should respond to volatility. I want to know where you stand. Now, here is what you actually do with all of this. Here is a simple action plan and no drama. Step 1. Write down your maximum silver allocation as a percentage of total investable assets before you make any moves. Write it down somewhere physical, not in your head. If you do not set the ceiling before the excitement arrives, the excitement will set it for you, and you will not like where it ends up. A silver is the awkward cousin of gold that shows up to the family event, does something wild, and then disappears for a while. It does not glide, it lunges. It takes the stairs up, then tries to jump out the window. Keep it sane. Silver does not need leverage to be exciting. It will provide the excitement for free. Step 2. Separate your understanding of physical silver from paper silver. A silver ETF and a silver coin sitting in your possession are not the same thing. They carry different counterparty risk profiles. They behave differently in stress scenarios. They offer different levels of actual claim on the underlying metal. Do not just chase the paper product because it requires less friction. Decide this first, then figure out what form of exposure actually aligns with why you own it. Step 3. And if you are building or adding to a silver position right now, do it in tranches. Set 3 different entry levels: a price at which you buy your first position, a lower level at which you add a second tranche, and a third level representing a more meaningful pullback where you complete the position. This approach turns volatility from an enemy into a tool. Do not make the common mistake of loading up at one price in a moment of conviction and then panicking when the price moves against you before it moves for you. Step 4. Put the 3 watch list indicators I mentioned into a simple document: lease rates, registered inventory levels, and primary miner cost margins. Check it every couple of weeks, not every hour. When 2 of those 3 indicators signal simultaneous tightening, you want to already be positioned before that signal becomes a financial news headline. Because by the time it is a headline, the easy entry is already gone. If you are a long-term stacker, your specific rule is this: your job is not to time the exact bottom. Your job is to accumulate at prices below where the market will eventually have to reprice to. Set a pace you can sustain without anxiety and do not deviate based on a single rough week. If you are a trader, your specific rule is this: the supply story I just described is not a trade setup. It is a multi-year structural thesis. Using this thesis to time a short-term swing is like using a geological survey to navigate daily traffic. Do not confuse narrative with mechanism. Know clearly which game you are in before you allocate anything. Now let us map two plausible paths forward without pretending we can predict the exact candle. Path 1 is the structural repricing scenario. In this path, the byproduct supply decline quietly compounds over several years. Primary mine output remains constrained by the capital access and permitting timelines I described. Meanwhile, industrial demand from solar panel production, electric vehicle manufacturing, data center construction, and grid expansion infrastructure continues to grow at a pace that current supply projections simply cannot absorb comfortably. Silver in this path literally becomes sandpaper. It gets consumed in panels, in connectors, in conductive pastes, and it does not come back. As above ground inventories are drawn down and the reservoir drains faster than new inflows can refill it, the market eventually has to reprice to attract the capital needed for new supply development. And when silver reprices, it does not do it gently. I am not predicting it. I am saying it is within the set of things this market is capable of doing, and the supply demand math makes it a serious scenario, not a fantasy. Path 2 is the demand disappointment scenario. In this path, the industrial build-out slows meaningfully. Policy support for solar and EV infrastructure pulls back. Battery chemistry innovations reduce per unit silver content faster than unit volume grows. Global economic slowdown suppresses both industrial and investment demand simultaneously. And in that environment, the supply tightness story does not reach its critical threshold before investor conviction breaks. Paper silver positions liquidate, investment demand retreats, and silver drifts sideways or lower for an extended period while the supply problem develops quietly in the background. That is not a crash call, that is a maturity call. Both worlds can be true in different time frames. Same asset, different interpretation, depending on which driver you weight more heavily. The supply story is real, but a real story is not a guaranteed timeline. Now, here is the uncomfortable truth, and I want to say this plainly because if you are not prepared for it, you will make exactly the wrong decision at exactly the worst moment. Even if every structural argument I just laid out is completely accurate, silver can and does get hit hard in the short term by forced liquidation that has absolutely nothing to do with silver's own fundamentals. When equity markets sell off hard and investors are facing margin calls and redemption pressures, they liquidate what is liquid and what has appreciated. Silver often sits in both categories, so you can end up in a scenario where a risk-off event that theoretically should drive money into hard assets actually drives silver lower first, because portfolios need cash and silver provides it. This is not contradictory. This is mechanics. Liquidity events do not respect narratives. And here is what nobody wants to say out loud. The large institutions that appear on financial media talking about silver